welcome to another episode of Think with a Drink. It's the weekly webinar series brought to you by the ARIES Foundation for Financial Education. And this week, our episode is the basics of investing. Next slide, just real quick. I'm not going to go through the checklist because we're in a recorded situation here. So you can fast forward through that. Thank you. Real quick on us, your presenters for this evening. My name is Tom Alessi. I am the president of the ARIES Foundation for Financial Education. I've been in financial services now for 23 years. I'm an investment advisor, which means I act in a fiduciary capacity whenever I'm giving guidance or advice to my clients. I want to bring my vice president in. Craig, why don't you introduce yourself?
Sure. So I'm Craig Richardson. I'm the vice president of the ARIES Foundation. I've been in the financial services field for a little over 17 years now. And I work with families and small businesses to help them come up with a financial plan so they can have a better relationship with their money.
Tremendous. And Craig will be chiming in as we go through this. So did want to say that this is brought to you by the ARIES Foundation for Financial Education. You can visit our website. It's www.ariesfoundation.org. Just know our mission, as Craig had said, is trying to help everyone have a better relationship with their money. So next slide. I forward through the disclosures because we want to get to the fun part of this. So we call this Think with a Drink, and the reason for that is that we're trying to do and give this education and information in a more relaxed and casual manner. And so what we're trying to do is we can't think of a better way to do that than if we have something cold to sip on. So we hope the audience will just grab something cold to sip on and imbibe as we go through this. Tonight we're drinking, this is Rec League from Harpoon, a local brewery here. It's a tremendous ale and something that you might want to try. It's a hazy brew that they put together. Next slide. So investing, savings, and investing basics. Go ahead. So the overview, we're going to do investing versus savings. What does that mean? Considering your risk, because for Craig and I, it's always about risk. Some terms and definitions, some stuff that gets thrown around. We're not really going to go too much into working with advisors and brokers and agents, and then some ideas that come up from there. So go ahead. All right, so the basics, right? Savings is just providing funds for emergencies. You want to be like saving up for a specific purchase, right? That's the idea with savings.
Correct.
You're not really trying to get some long-term growth out of that, right?
Correct. Typically, you're trying to put it in a very conservative approach because you may need it very soon.
Yeah, and so you don't want to be taking, we're going to talk about risk a little later. So investing is sort of the flip side of that, right? So investing says, I'm going to focus on increasing, I'm going to try and achieve longer term financial goals. So it's really sort of that separation when we talk about this. Short term, really about savings. That's what we talk about, emergency reserves and funding, those type of things. Those are usually in the bank. Investing, that's when we're talking longer term, things that can have a little bit of fluctuation in return in terms of what's happening in the market. Go ahead, next one. All right, so we mentioned emergency reserves. So real quick with that, you know, one of the things that Craig and I try to preach to everybody is that you should have an account set up that is just for emergency reserves. What do we say, usually 3 to 6 months?
Correct, depending on whether you're a single income or dual income family. Yep.
Right, so something in those lines that should be in an account that's separate from, say, your checking or your savings or anything that you can get access to with a debit card. We want your emergency reserves to be set aside. That's just there for when the emergency happens. That's where I'm going to, so I don't have to use credit or get into debt when I have that emergency arise. Next slide. All right, so participating in a retirement plan. So if we think of this, the way Craig and I explain it to everybody is that it's really about 3 different buckets when we're talking about savings. That first bucket is that emergency reserve fund, like we talk about. Bucket number 3 is your long-term, which for most of us means retirement plans. So you want to make sure that if you have access to it, that you are taking advantage and participating in the company retirement plan. This is pre-tax, it's ongoing, and you are buying as the market happens, going up, going down. Different types of plans, 401ks, 403bs, and IRAs, all know they're pre-tax, and you can pretty much move in between them. So next slide. So investing, right? that's putting money into an asset that's going to generate a return, right? So, the idea there is I'm getting something back on my money by putting this money into this.
Well, you're putting your money to work,
There
right?
you
You work for your money, and now you're going to make your money work for you. And the only way it's working for you is if it's bringing something home.
That's it. And so, and one part of this that we talk to everybody about is the difference between investments and speculation. We did a whole thing on chasing Bitcoin, basically, in terms of, so speculative investing is okay in a limited amount, a limited basis. Just understand that if we're talking about specifically things like your retirement or that I'm saving for my child's education, cryptocurrency is probably not the place that you want to be putting those funds, right? So that's speculation versus I'm trying to just generate some sort of growth on my asset or my return.
Or the new engine that's coming out that you
Yes.
have to invest in, right?
Yeah, whatever it is, right? Whatever the next crypto or the NFTs, I put that in there. Next slide. All right, risk. So for Craig and I, it is always about risk. What happens for most people is that they talk in this about what's the return, right? How many times do we get that? Like you'd sit down with somebody and they're like, well, what's it returning? Or what am I going to get on that? Or what's the payout going to be on it? And for us, it's not about the payout. It's not about the return. It's about how much risk you're willing to take. And there's different types of risk that are involved, right? So you've got, interest rate risk, which is what's going on right now, because we don't know where interest rates are going. The Fed is talking about raising or they're tapering and then they're going to raise interest rates. You have inflation risk, right? That's just meaning that what's happening is the price of goods is going faster than the ability for the value of money to purchase them. Why don't you talk about market risk?
Sure. So market risk is associated with movement in the market, and right now we've seen incredible moves in the market, and it's never when do I get in, when do I get out, right? So that's trying to do market timing is market risk. The big thing though when you're talking about risk is what it says here. What's your tolerance level? So while risk and reward is an inverse relationship, the more risk you take, the higher the reward can be, and vice versa. If you take very little risk, your reward might not be as great. But the issue is what allows you to reach your goal and still sleep at night, right? That's really what your tolerance is. If I'm very nervous all the time about my money, then I may be taking too much risk. If I'm very worried I'm not keeping up with inflation or going to make my goals, maybe I'm not taking enough risk. So it's really about understanding you personally as an investor and what works for you.
Yep. Next, right? So reducing risk, which is basically diversification. So the idea of spreading out, don't put everything in one place. Certainly don't put it all into Bitcoin, that type of thing, right? Asset allocation refers to the mix of different asset classes. We're going to talk about that in a second about how those break down. But what happens for a lot of people is that they end up having duplication because of what happens. They have one account, they got an old account, they got another old account, and what they end up with is a lot of assets sitting in the same place. Next one. Bonds. So the opposite of equities. Equities are stocks. That's ownership in a company. Bonds are a debt obligation. You've lent the company money. You are getting a return on that. It's what is known as usually as the coupon that is being paid out from the bond. But every bond has a maturity. It's either very short term, 1 year, to very, very long term in 30 years. Treasuries are done anywhere from 3 months to 30 years. So understand that bonds generally are done based off a par value of $1,000. I bought a bond, it's $1,000, it's going to pay me X on a coupon. That's what I'm getting as my return. Once the time limit is up, it was 5 years, 10 years, they're going to give me back my $1,000. That's how a bond works.
Now bonds can be issued, bonds can be issued by state, local, or federal municipalities, correct?
As well as corporations.
As well as corporations, okay.
Correct.
I don't think everybody understands that.
Yeah, so and I'm going to do that in a second. Now go to the next one. Right, so bonds get issued based on credit rating and time horizon. That sort of breaks it down. So when Craig mentions about the U.S. government, the U.S. Treasury, that's the highest you can get. That is the AAA, right? That is the highest level you're going to get on that. To what is low quality, and that is below triple B rating on a bond scale, those are companies that, well, they're not necessarily going to be around. You know, that bond may not end up at its maturity because they may default on it. And then you have short term, which is generally anywhere from usually about 30 days to 2 years. Mid is about 2 years to 7 years. And then long term, as far as bonds are concerned, are 8 years and beyond. Next. And these are the types of bonds. We just talked about that. You know, so you have corporate bonds, you've got treasuries, those state agencies, those municipal bonds, as Craig said, you know, same thing. The one that's in there that I think gets a lot of people is junk bonds. So junk bonds are those bonds that I was just talking about that are companies that are triple B and under. And what happens with those companies is they have to pay more for that debt. Right? So you're going to get a better spread, as it's called, a return on that coupon because the company's got to pay for that. Not necessarily nobody's lining up to lend them money, right? But you run the risk higher of default on that bond. Just know junk bonds have a wide spread, whereas municipal bonds or treasuries have a very, very narrow spread. That means from the high to the low. Junk bonds have a wide spread as to what can happen because it all depends on the company and the rating and what happens to them and whether or not they're going to repay you. Next. So investing terms, active versus passive, right? So active means you've got oversight. There's a manager. Somebody is watching that. Somebody is actually acting on your behalf, making trades, watching what's happening, and selling the investments or buying based on the parameters that are going on in the market. Passive, which has really been sort of a in vogue thing for the last, you know, say 30, 35 years, is buying an index. And that's whether it's the S&P 500, whether it's the Dow Jones, and we'll talk about those indexes in a second. But essentially all you're doing is buying whatever the mirror of that index is doing. And all they're doing is buying based on the percentage of holding inside that index. Next slide. So here's the indexes. And these are just the, 4 basic major indexes that are out there. You've got the Dow Jones Industrial Average, the DGIA, or the Dow as most people refer to it, which is just a composite of 30 stocks that represent the greater market as a whole. That's the idea of the stocks that are in the Dow. So a lot of times you'll see the Dow has moved radically. Well, it's because there's only 30 stocks in it. The S&P 500 has the 500 largest companies in the U.S., and they are broken down based on a percentage, their capitalization of the U.S. marketplace, the domestic market. You know, like Walmart is number 1 or number 2. They've got the largest capitalization inside there. So they've got, like a 2% holding of the S&P 500. The Russell 2000, we're talking smaller companies. Those are small caps. We'll go through those definitions in a second. And then you have the Morgan Stanley Capital Investment EFA, which is the Europe, Asia, and Far East. Pretty much think the rest of the world except for the US and Canada. That's what that means. So you've got the MIFA that encompasses the rest of the world as an index. Next. So stocks, much like bonds, have the same sort of grid box approach, except for in their case, they break it down instead of duration, they're breaking it down by value blend or growth, how those companies are investing, and then size, large, mid, and small. Now, a small cap means any company that's got less than $2 billion in capitalization. A mid would be anything from 2 to 7 billion, and large caps are anything over 7 billion in capitalization. So, these are massive companies when you're talking about it. Value versus growth, right? Think value, think more blue chips, right?
Okay.
Think, financials, companies that they're not going anywhere. For them, the idea of trying to grow or radically grow is very limited. Whereas a growth company, most of that is technology, right? Healthcare in some cases, where you can have exponential growth. You can be doing 2 to 3 times earnings sometimes in a given year. The blend is just a mix between the two of them, right? I'm a little bit of both in that case. But just know that whenever anybody says, well, hey, are you in large caps or small caps or whatever it is, that's what they're talking about. Talking about the capitalization of the company itself. Next. So investing in stocks. These are, if you're going to get into equities, this is the ways that you're purchasing equities, right? Because you're buying a part of the company. So that share of stock buys you a piece of the company. Yes, I can say I own Disney. I have a share of Disney stock. I own Disney. Hey, how about that? That's what you get, basically.
Can you give me a speed pass?
Yeah, no.
Okay.
You don't even get a speed pass. You don't even get a turkey leg. You get nothing,
Ooh.
right? Depending on the stock that's being issued, some companies can basically recall the stock, right? And then the types of common stock, when we talk about blue chips, we really mean those companies that are like in the Dow, the companies that are there, that are dividend producing, that are long term, that are not cyclical, that are going to be around for a while. Growth companies, again, that's more like technology. Income, those are ones that are producing that dividend on a regular basis. We've already talked about speculative and defensive stocks in terms of it. So next slide.
Well, common stock also allows me to vote on what's going on in the company, correct?
Correct, right? A common share in terms of that.
Yep.
All right, so one of the things that does come up is this idea of mutual funds versus individual stocks or bonds. So why mutual funds tend to be a little prevalent is you've got a basket of whatever that position is. If we're taking US large cap, well, they're investing in companies that pretty much fall into that category, not one individual company. And the likelihood that all of the companies that are inside that mutual fund are going to go or tank at the same particular time or go out of business is very unlikely. Because mutual funds will hold anywhere from, say, 40 or 50 to 200 to 300 different shares of companies.
So if I have trouble choosing, this is a great way to do it because I get a little bit of everything.
You get a little bit of everything. And the same thing with bonds. The same thing, that's what happens in the bond markets. Like I said, and especially when dealing with junk bonds, that spread is so wide. Like you could have one junk bond that in 1 year returned, a plus 10, 12%, and then the worst performer was minus 20. Well, so if you guessed wrong, you're in the downside. Whereas in a mutual fund, they've spread that out among all of it. So you take a lot of, as Craig talked about before, the risk out of it of, gee, am I in the right place or the right one? So that's why mutual funds, and you'll find them a lot in your retirement plan, you'll find them a lot in different investment portfolios because it does spread the risk out. Next. So these are some of the terms that get tossed around right now. And one of them that you're going to hear frequently, I think, from where we are today into 2022, is this idea of a market correction. A market correction means a drop of 10% from the most recent 52-week high. Well, in the case of October, the 52-week high was last week, right? So the 10% drop would bring you dramatically down from where we are now. The S&P 500 at 4,500, which means we dropped down to just about over 4,000 on the S&P 500. That would be a correction, right? A bear market means we've declined 20% from that high. That's when we start getting into talking about recession and other things that are going on. One of my favorites, because it's been talked about and bandied about left and right, is tapering. So tapering is the Federal Reserve Bank doing their bond buying program, and now they're going to reverse that and get out of the bond buying program. Understand right now the Federal Reserve Bank is buying $120 billion a month. What they've talked about is starting to ease that, stop that buying by $15 billion a month, beginning sometime in November or December of 2021. We'll see what happens, but that's what tapering is talking about. And then you have inflation. That's the other fear that's going on right now, which is the increase of prices at the fall of purchasing power of money. Next slide. So we talk about the cycle of emotions. Like every market cycle goes through the same emotions. We start on optimism. Okay, I'll get in. We buy on euphoria. Look, everybody's in. Even Nana and your grandma, your grandpa, everybody, they're getting in, right? That's euphoria. Everybody's buying. Everybody's saying you should be buying. What happens is that eventually we crest over the top there, and we start to get into a little bit of denial. Wait, I can hold on, right? Wait, fear, and wait, what am I doing? And then it really starts to bottom out. We get in depression, and that's when we sell. And then it starts back up again. And the whole idea, as Craig and I have always said, is what we're trying to do is to take the emotion out of your money. Take the emotion out of investing, try to find the path and stay on it, because as the slide says, the only person who ever gets hurt on a roller coaster is the guy who tries to jump off mid-ride. So stay the course, just find the right mix for you. Craig talked about finding that risk tolerance, making sure it's the right fit for you. Next slide. Right, so avoid fraud. So anytime you're dealing with any guys like us or anyone, you always want to check them out. That line on the bottom of the screen there, that's brokercheck.finra.org. You can look up anybody's past history, you can look up anybody's dealings and see what they've done. In my particular case, that number on the screen, 326-8500, that's my number. You want to go to www.brokercheck.finra.org, you type in 326-8500, you're going to find out everything about Tom Alessi, what I've done, where I'm licensed, and if I've had any prior filings against me, and in my case, in 23 years, that answer is no. Next slide.
Was Bernie Madoff's number up there?
No, Bernie was not in the securities database. So for ARIES, what we try to do is we try to help everybody have a clear vision of the road ahead. You know, we know that there's bumps and sways and things that go on as you're trying to figure out where your financial goal is and where you want to get to. And our whole mission, our whole goal is trying to help you get to whatever that place is that you want to be. Our whole goal is trying to make sure your financial security is set. Next slide. So one of the ways we do that is trying to help everybody plan, sort of get a sense of where you're going, what you're trying to do. You may be all set. You may have the whole thing in place. I think you can hit the button because the little yes is going to pop up. Yeah, so don't worry about that because you can do it. You can reach out to us. We'll talk about that on how to contact us. But in order to understand where you want to get to and where you want to be, this is, you know, reach out to us, right? That's the whole idea.
Well,
right?
everybody has a coach. Even Tom Brady has a coach, right?
Yes.
It's good to have some coaching.
It's always good to have somebody there, even if it's to do nothing more than just take a look at and review like what you want to do or what you've been thinking about. Next slide. All right, so this is Craig and I in our more formal attire.
In our number 12 Brady jerseys.
He just mentioned, you know, the GOAT, the greatest of all time, Tom Brady. Yes, those are custom jerseys for us. We do a lot of presentations at organizations, community support groups. We're out at events and so on. And so some of the times we're doing some of these events, we're out there in you know, let's face it, the GOAT's jersey. So we like to have fun with that. It's one of the things that we try to do. He's still playing, so as long as he's still playing, we're still wearing them. And let's face it, at this point in time, you can't find a Mac Jones jersey anyway. So, you know, you might as well do that. But we have fun with that. Next slide. Right, so if you ever have any questions, whether it's on your investments, on your portfolio, you know, one of the things we like to talk to everybody about is the idea of crash testing your portfolio. See, because when you do investments, and one of the things that's there, and it's funny because we talk about this with the retirement plan stuff, is about rebalancing your portfolio. Right? The rebalancing means going back and just double checking. I invested in 4 funds at 25% in each fund. Well, I'm going to bet that 1 year later, those 4 funds don't have 25% in them anymore. Something did well, something did worse, and you might have the other 2 in between. You want to go back and reset it. But what's going to happen if the market corrects itself?
Yep.
If inflation goes up, if gold goes up, if the GDP goes down, that's what we mean by crash testing. So if you ever want to reach out, if you want to have somebody take a look at that, we're happy to do it. That's part of what we do. You can reach us at www.ariesfoundation.org or shoot us an email, info@ariesfoundation.org. We're always happy to answer questions. We're always happy to, you know, try to help anybody out. You also see on there, you've got the blog post. That's www.ariesfoundation.org/blog. We do a lot of pieces on this in terms of what's happening in terms of the blog post. So if you ever need any assistance, you ever want any guidance, you ever want any support, our goal is trying to help make sure your financial security is set. Reach out to us. We're happy to help. And on that note, we're going to say good night.